Hi, everybody. This is part 2 of my series about using Excel financial functions in VSCode. And I thought in this particular video, I will cover a couple of functions that you can use related to an accounting method called depreciation. There's amortization, there's depreciation, and these are cost allocations, and it's performed in accounting in particular, whether it's for tax purposes or it's for general accepted accounting principles purposes. So I thought in this video, I'll take you through a couple of calculations and I'll demonstrate how you can use this depreciation allocation. I realize this is accounting, and accounting is very dear to me because that is part of my background. Although inactive, I have passed the CPA exam and I am licensed, but I'm not practicing, so I'm in active status. I used to teach accounting for several years at the university level in Columbus, Ohio, a place called Franklin University, along with some other courses I was teaching in finance and computer science. However, accounting is very dear to me, so I thought it's nice to revisit some of the concepts in accounting. It's been many, many years since I had looked into this, but I kind of got a renewed interest. So I thought I'll share this with you, and hopefully it's interesting for you as well. The beauty of accounting is that unlike tech and unlike IT, where you constantly have to relearn new skills because everything is changing constantly, accounting is very stable, if you will. There's very few topics in accounting that changes, but it might be stock options, might be how you account for investments, and of course, the international arena, it might be some changes in rules. But a lot of the concept stays the same, and they haven't really changed over the years. So it feels like comfortable to go back to it for me because I recognize a lot of it hasn't changed that much. So without further ado, let's get into it and let me show you what I have prepared for you. For tax purposes, when you have property, plant, and equipment and you want to depreciate it for tax purposes, you have to follow what's called these MACRS. What it stands for is the Modified Accelerated Cost Recovery System. And there's all kinds of rules here, and it gets complicated because depending on how much you use for personal use, how much you use for business use, you have to take fractional percentage, etc. So there's also deductions you can take, like the 179 deduction. So it gets complicated. The IRS doesn't take any chances. They're not going to leave it up to you to try to figure out stuff. They're going to give it to you the way they want it to happen. So what they have in this publication, they have this. They have tables that tells you, okay, so you have a property. Well, we want that property to be classified in either a 3-year, a 5-year, a 7-year, 10-year, 15-year, 20-year, 27.5, and so on. Property classification schedule. And we're going to give you the percentages you can use to calculate your depreciation expense for tax purposes. It uses what is called a half-year convention. Now, behind the scenes, the method used by the IRS is called the double declining balance method. You have a choice. You can also use what is called an optional straight line method. But for the purpose of classifying your property, you have to follow whatever the category it falls under. So if it's a 7-year classification, you can only take 14.29% depreciation expense in the first year, and then only a 4.46% in the last year. But notice, because you take half the first year and half the last year, it's not really a 7-year, it's over 8 years because you're taking half on each. So it becomes a little different here if you look at it. So half-year convention means it assumes that you're putting it in at the last half of the year. So only getting half the depreciation and only half the depreciation at the end. So that's what these tables are doing. This is called a Modified Accelerated Cost Recovery System. And that's an IRS thing. So that's one part of it. For accounting purposes, you don't use this. You have a second set of books where you use the general accepted accounting principles. And if you look at that, I prepared a spreadsheet here, and I'm showing you some different methods you can compute this. So the idea here is I'm going to go fairly quickly through this because I don't want to waste your time. You can always go back and read up on this on your own. But let's just go through some core concept. I have an example here, so let's read through it. On January 1st, 2022, Tools R Us company, a made-up name, A small machine tools manufacturer acquired for $1,073,000 a piece of industrial equipment. The new equipment has a useful life of 5 years, meaning for accounting purposes, the company paid $15,000 for shipment, and they also paid another $12,000 for ready the equipment for its intended use. So it's setup cost, in other words. The salvage value, or so-called residual value, is estimated to be $125,000. So what that means is that at the end of 5 years, which you estimate to be the useful life, you can sell it for $125,000. Now, for tax purposes, you'll have to pay a capital gains tax if you earn money by selling it. For purpose of GAAP, you don't. You just use this for the purpose of figuring out how much is your depreciable basis. We also think that if you don't base this on time, but you base it on usage, you think that this new equipment can produce 12,000 machine tools in the first year, and then it declines by 1,000 per year after that. So 12,000 the first year, 11,000 the second year, 10,000 the third year, and so on. These are methods for general accepted accounting principles: straight line, the double declining balance, sum of years digits, and activity method. So we're going to look at each one, how to compute these. Now, for tax purposes, this property, the machine tool and manufacturing property, will fall under a 7-year classification. So we'll have to use those MACRS tables to compute this. And those percentages are given by the IRS, so we're going to use those. Now, here is the question: which depreciation method would maximize net income for financial statement reporting? So that's related to GAAP for the years ended December 31st, 2024. So we're going to prepare a schedule, and we're going to show the accumulated depreciation and so forth. We're not going to deal with present value, meaning the time value of money, income tax, and deferred income tax consideration, which is a second type of topic, if you will, that relates to corporation. We deal with taxes versus accounting methods. Now, the second question here is, which depreciation method, if you use the tax depreciation methods, the MACRS or the optional straight line, would minimize net income for income tax reporting for the 3 years ended? So we'll look at that. All right, so the first method is the straight line. Very simple. Take the total cost, meaning what you purchased it for, and all the costs that are related to creating this property for its intended use. So in other words, shipping, setup cost, whatever, all that goes into the cost of setting this up so it can actually produce something. So the total cost, therefore, is $1,100,000. Now, there's also something called salvage value, which means you expect to be able to sell this at the end of year 5 for a certain amount of money. You know, it's not very scientific, but, you can make up these numbers. But when you do that for the straight line purposes in accounting, you call this a depreciable basis. So you take the total cost minus the salvage. That will be what you're going to depreciating this over. For straight line, you depreciate equal amounts over a certain useful life. So in our case, it's 5 years. So the equal amount, therefore, becomes, using the Excel formulas, is SLN. That's the formula. It contains cost, $1,100,000, salvage, which is $125,000, and the life is 5 years. So you put that into the formula, and you end up with $195,000. Then you accumulate this. So for the first 2 years is this, for the first 3 years is this, and for all 5 years is this. So that's the accumulated number. So that is equal to the depreciable basis, as you can see, minus the salvage here. So that's the straight line. The double declining balance method takes bigger chunks originally in the early years of depreciation. So it lowers your taxable income for one, if it's tax-based, but also it lowers your accounting income a lot more too, as you can see. Now, what you're looking at here is that two things about the double declining balance. This goes for the tax purpose too, is that you don't base it on the cost minus salvage. You base it on the actual cost. So it doesn't even consider the salvage value. The only time it considers the salvage value is when you get to the last depreciation expense. you have to make sure that your book value, which is the beginning book value, which is basically the cost for preparing all this one, minus the depreciation expense. That would be your ending book value. So as you go through the years here, the beginning book value for year 5 was the ending book value of year 4, which is 142,560, minus the depreciation expense, will give you the ending book value. Now, the trick about the double declining balance method is that you cannot go below the salvage value. So notice here is 125,000. That means you could only take $17,560 as the final depreciation expense. So that's a little tricky, but something worth noting about. The sum of the year's digits is basically reversing everything. Again, there is a SYD formula for it. And in case I didn't show this, let me just quickly go back. There's a double declining balance here, cost, salvage, life. And if you look at a life, okay, that's the 5 years. But what is period? Well, period is you're computing this per year. So you're referring back to 1, 2, 3, 4. So if you look at the formula here, the C3 is referring back to year 1. If you look at the third year, you can see that the C5 is referring back to the year 3 and so on. This 2 here indicates there's a double declining balance. Now you could use the same formula here, the DDB formula, for declining balance. So let's say you only had 150% instead of 200%. Then you can simply say 1.5 here as a factor, and that will solve that. So this is useful because it can be used for more than one thing. However, by default, it will use the DDB. So use 2 as a default parameter for the factor. Now, the sum of years digits is basically this formula. And as you can see, it contains pretty much the same stuff. Cost, salvage value, life, and per. What is per? Well, it simply refers back to the year itself. Sum of the years digit is, the first year will be 5/15 because the sum of the years is 1 plus 2 plus 3 plus 4 plus 5. That's 15. But when you do this calculation, you're basically saying 5/15. Then you say 4/15, 3/15, and so on. And that's how you come up with these expenses, even though you use the formula. But that behind the scenes is what it's doing. Okay? So that's the sum of the years digits. By the way, in case you wonder, based on accounting trends going back years and years, if you have 1,000 companies, 800 out of those 1,000 will use the straight line method. And the least used one will probably be the sum of the years digits. AM, what is that? Well, that's activity method. Not everything is measured in years or time. What do? Well, maybe you have to base your depreciation on how much usage you have instead of time itself. Maybe 5 years is covering what you're actually doing. Maybe the equipment you use is being used all the time. So maybe you'll wear it down much quicker. And if so, how about we do it based on activity instead? Can we do that? Yes, you can. So if you notice here, you still have the total cost here. You have the salvage value. But then you estimate how much would this equipment being used in the first year, second year, third year. And in this case, you say, well, I think it's going to produce 12,000 units, small tools. And then the second year, maybe 11,000. Third year, maybe 10,000. So you make some estimates here. And then you say, over the 5 years, I think I'm going to be able to produce 50,000 units. So what do? Well, in order to calculate that, you come up with a rate. So the fraction will be equal to depreciable basis, which is the total cost minus the salvage value, because you do expect to sell this after year 5. So that's 975,000, and you divide it on the total output over the 5 years, which is 50,000. That gives you a rate. Then it's simply a matter of taking that rate times the 12,000, times the 11,000, and so on. And that gives you the actually activity method of doing this. Now, there is no Excel formula for this, so I just put no Excel formula. Now, what about MACRS? Well, that's for tax purposes. Here are the table that I captured from that publication, and I simply converted it into percentage form here, as you can see. Here I created a table that actually used those percentages. So when you look here, H13 refers here, you don't subtract the salvage value. So you have to use the full total cost amount. So that's 1,100,000 times the given percentage. We're going to base it on 100% used for business. So that becomes, for the first year, half year convention, you take half the percentage. So that becomes 1429. For the second year, you use the full percentage, double declining balance percentage of 24%. So whatever these percentages are, you have to use them for tax purposes. So depreciation, therefore, for the first year is 157, 190. Second year is 269, etc. And if you're going to sell it at the end of that last year, you still have to pay taxes on it. Here is the optional straight line. Notice the same as MACRS, except for now you're doing a straight line computation. So you have the half year here and a half year here. So you can, otherwise it's straight line. So it's very similar, but you don't use those percentages given. You just compute it over the whole thing. And that's what you see down here. These are the percentages. And here is the total. It adds up to the total cost of the asset. Here I simply have a table that includes all their depreciation expenses, MACRS and non-MACRS. Here is the accumulated version of it. And here I just create this table so I can chart it. And here's the chart. So as you can see, double declining balance reduces the amount of taxes dramatically in the first few years. But then it goes lower than the straight line is in the latter years. So there is consequences regardless how you do it. But that's pretty much what I wanted to show you as far as the spreadsheet goes. Okay, before we start looking at the actual VS Code formulas, let's just take a quick second here and take a look at what the answers would be for those questions that we had in our example. So here is our example. Let me bring it up so you can see it. So A is asking for which depreciation method would maximize net income for financial statement reporting for the 3 years ending December 31st. So each year you take depreciation expense, and the more depreciation expense you take, the lower your net income will be, obviously. So if you look at the data here, you can see that assuming you have these different methods here, which I laid out, and if you look at it, you have the straight line here like this, by 195,000. Now it happens to be that the sum of the year's digits are the same number as the straight line and as the activity method here in the third year. Okay, so if you look at the activity method, you can see that's this number right here. However, if you look for the total period over the 3 years, the straight line, you would have taken the least amount of expenses. Therefore, the net income would have been highest using the straight line method. It would be the total of these three, so to speak. So I just put it here, just use some dummy numbers just to kind of illustrate this. So the answer to A should be straight line, even though in the third year they show up with the same amount. But over the 3 years, net income would have been affected, the least would be maximized, in other words, by taking the straight line depreciation method. Now, what about for tax purposes? You want to minimize your taxable income. Well, the question therefore becomes, which depreciation methods, the MACRS or the optional straight line, would minimize the net income for income tax reporting? Well, it's pretty obvious. If you're using a double declining balance method, you're taking a bigger depreciation expense, and therefore you lower your taxable income more. So it makes sense that the general MACRS method with all those percentages will lower your taxable income the most in the early years, and then in the later years it will even out. So the answer to part B would be the general MACRS, or in this case, this one right here. So that will be the one that answers question B. Okay, so here I am inside my project, and I want to go through this fairly quick. And if you have any questions, please make a comment, ask me a question, and I'll go through in more details. But it's already getting late here in my video. Notice I set a reference to that NuGet package, excel.financialfunctions right here. And I'm creating a class here. And what I do is I create a dictionary that consists of a tuple of int, string, and a double. I call it table here, and there's a new one. So here you can see I have index 1, 2, 3, 4, and that's for the first category, 3 years. There's for the second category, 5 years, and so on. And then I give it the category classification, and then I give it the percentage per year. So that's basically what I create here. It's a long one here. Second one here is the get rate. That's going to actually extract out one of these values depending what I'm passing. The second function here is simply get percentage count, which means I will calculate how many records there are within each classification. So if you look at it here, hey, 15 years, okay, we have 20 years. We have from row 57 through whatever it is here, 77. So that will give me the total so I can create an object later to hold those values in a list format. So then I have another class called TVM parameters, which is time value of money parameters. And I basically create something for everything I can imagine that I will pass in. So it's for depreciation. I use some of them. I use cost, salvage, life, period, and factor maybe. But for other time value of money, I might use some other ones like beginning, end, like start period, future value, payment, etc. So I just created one big container here to hold it all. Here I just set the parameters, so I have a value for each one, like a default value. That's all I do here. And then here I have a parse command that is a for loop that calculates based on whatever you're passing into me. This is what I'm going to be looking for, the length of how many arguments you're passing in. Then I'll be looking for whether you pass me in a function, you pass me in a cost parameter, whatever you pass me in. And for each function, I will look for this and I will capture the value you passed to me. Here is the main function. So I create a default P, if you will, that relates to the arguments you're passing in. And then I look for, hey, which function do you want to run, okay? Based on this argument here, if you passed in PV, like this, text string, then I will run this. Otherwise, I'll run this, etc. So whatever function you're passing in, I will run it like this, and I will call the right Excel function to do this. So that's what this does. In addition to using formulas and stuff that are related, I also create my own code here, as you can see. I still use some of the functions, but here, for example, I create a schedule. So it's a little more involved. In particular for the MACRS stuff, you can see it down here. I do it all by hand here. I don't have anything to relate to. I do to get the rate to find out, certain information. But again, if you have any questions on this, let me know. Now, let me see how you can actually run this. Well, you can go to New Terminal. That's one way. Notice I'm passing in the function here. So I'll be looking for this SLN function and run that one. Here's the cost, salvage value, and the life. So when I run this, notice it takes a while, and it comes back with the depreciation expense like this. Now, that may or may not what you want because it's very slow. A faster method might be to use the compiled version of your code. So let's look at what that will look like. So let me open up a folder, and let's go to wherever I store this. So we'll go in here. That's probably okay. Go to bin, debug, and notice under here you have an executable, Excel function exe. So all I have to do is type cmd like this, and it opens up a command window like this. Excel function exe is what I'm calling, which is this guy here. And then I'm passing in the MACRS, in this case, cost, and the MACRS grouping of 7 years, etc. Hit enter, and notice it comes back right away because it's compiled. And here I created a schedule of MACRS calculations. As you can see, I have the cost, the percentage used, the depreciation expense, and the accumulated depreciation. So it gives you a much quicker way of getting this. Now I'm going to leave all this stuff in my repository for this video, and feel free to use it. And I hope you like this video, and if so, give me a like or consider subscribing to my channel. That will help. Thank you so much.